what you're seeing?
I
Yes,
yeah,
no?
I see it. Yeah, it
Okay,
looks good.
great. That's fantastic. Let's get going. So, the this presentation is called "How to Combine Three Market Indicators with One Killer Strategy to Win Over 80% of the Time While Paying Almost Zero Attention to Your Trades." And that's a really accurate description of what you're going to see here. And I love the strategy because it it just has a real high percentage of winning, and that's an easy thing to get used to. So this is me. To make money in the markets, it's really important to have great tools for market direction. And these three indicators and one killer strategy is going to help us do that. And my name is Peter Schultz. Our website is Wealth Builder Publishing, but the strategy and the technique that you're going to see today is called the winning secret. And that's actually a domain. You can go there and you can check this out. I've been trading every day for almost 29 years, options. And I used to trade options like everybody else. And like everybody else, I lost a lot of money. And one day I decided I've got to do something different. So we're going to get into that. So you're going to see three great ways to tell market direction, and you're going to get something even more valuable. And that is how to still win on your trades, even if you don't get the direction perfect. So in this short presentation, I'm going to reveal a complete system for creating wealth. Really, it's more like cash flow. I mean, wealth is great, but in order to invest and create wealth, you need to be bringing in more money than is going out. And this should really help you do that. It's been really good for myself and our subscribers. And the reason for that is we create probabilities that are overwhelmingly in your favor. So you don't have to be so good because the strategy is good. Just all other things being equal, you win. So let's take a look at these three indicators to stack the odds in our favor right off the bat. And our first indicator is Bollinger Bands. And some of these indicators I'm sure you've heard of before, but sometimes we don't use them correctly, or either that or we overlook them and we don't realize the importance of the indicator. And so I'm going to just kind of work with you a little bit to show you actually how to use these. So what the Bollinger Bands do a really good job of is they identify the overall trend with several moving averages, and the center is the arithmetic mean, the moving average, and then the blue lines on the outside are um, deviations from the mean. And so they're equal deviations. So what they tend to do is mark the high and low points based on the bands, and they provide a relative definition of high and low. And by definition, the price is high towards the top of the band and low at the lower band. And these are not absolutes, but they give us a good idea of whether or not the stock is getting overextended to the upside or the downside. So this is just kind of looking at this trend at a glance. And the middle line is a 20 period moving average shown in red, and it's flanked on either side by blue lines. It's two standard deviations from the red center line. So these two standard deviations tend to contain the vast majority of the stock's movement. So John Bollinger is a technical trader. He lives in Los Angeles. He's the one that came up with this, and he's still around. He's still alive, and he's done a lot of research on these bands. And he tells us that 95% of the price action will be contained within the band. And that's the vast majority of the price deviation. And you'll see, and I'm going to get my little pen here so we can kind of see what's going on. You can see periodically where you'll have a little dip below, uh, except it invariably doesn't last too long. You get a little dip and then an almost immediate reversal. It's very rare to see a close like we did here actually below the band. And even then, it pops right back in fairly quickly. Right here, we have a close slightly outside the band, but it immediately goes back inside of it again. So it's a great way to separate periods of low volatility from high volatility. And we see that when the bands narrow. So when the bands narrow, like you see here, this is a period of low volatility, and periods of low volatility are almost always followed by kind of explosions of higher volatility. And we can actually see that in the price action. We can see where it's kind of going sideways here and then it jumps up. And anytime we see these bands narrow, like right here, it's almost immediately followed by an expansion of the bands and a fairly big move. In this case, it happened to be a gap lower. So that kind of tells us something is coming. So Bollinger Bands are considered a semi-effective indicator with only a 47% success rate when traders go long at the bottom of the band and go short at the top. But in this presentation, you'll see how to improve that success rate to over 80% by using the same bands but changing the strategy. The reason this isn't super effective for pinpointing a reversal is, say you saw this drop right here, this gap lower, and it actually dipped below the band and then returned inside of it, and you decided to go long at this point. Well, what we've seen and what you can tell just by looking at this chart right here is oftentimes the stock will slide along the band for a ways, and it'll actually stay there for a while. So it does not pinpoint reversals. This one had 3 upside moves, 3 days before it finally reversed lower back inside the band. That's why it's not good for using as a reversal tool, but it is good to tell you when something's becoming overextended to the upside or the downside. That's relevant right now in this current market because we're been fairly extended to the upside for a while. So people are still betting on the upside. When you see that trend, you kind of have to bet on it. But everybody's realizing you could have a major reversal here fairly soon. And we're going to take a look at the seasonalities. We're going to take a look at what's happening now and when that reversal might happen. So our next indicator is the moving average convergence divergence. This is another one that you probably have heard of. It's a fairly popular indicator. One of the reasons I like to use popular indicators is because so many people use them and agree on them. So in the short term, the market is a voting machine with different stocks. It's how many people think it's going to go up and how many people think it's going to go down. In the long term, as Benjamin Graham said, it's a weighing machine. So the fundamentals make a big difference over the long term. But in the short term, and if you're a short-term trader, and that's what we're talking about, particularly with options, you really have to view it as a weighing machine. So if everybody is using the same technical indicators or the most popular ones and the same patterns, when something happens, the majority of the people agree that, yes, this is a bearish signal. So the stock is likely to go down, or everybody agrees this is a bullish signal and the stock is likely to go up. And also the MACD is just enormously effective. So the MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average, which is a good combination for the length of time that we're in these trades. So the MACD is an oscillating indicator fluctuating above and below zero. It is both a trend following and momentum indicator. So you can see that there's a lot of movement on this chart above, and then you go down below and you see that movement reflected on the MACD. What's kind of cool is the MACD gives you a little bit of an advance warning when something's going to happen, and it also gives you the momentum with the moving averages. So one basic MACD strategy is to look at which side of zero the MACD lines are on in the histogram. And so this is the histogram here. Histogram are these lines that you see here. And if it's above zero, essentially the stock is in bullish mode. If it's below zero, it's in bearish mode. Potential buy signals occur when the MACD moves above zero, and potential sell signals occur when it crosses below zero. So that's just the very basic use of the MACD. Signal line crossovers, and so that's what we see here. It's what we see here, what we see here, what we see here. Signal line crossovers provide additional buy and sell signals. A MACD has 2 lines, a fast line and a slow line, and a buy signal occurs when the fast line crosses through and above the slow line. A sell signal occurs when the fast line crosses through and below the slow line. Okay, so you can see, if you draw these straight up, you can see that this crossover, if you would have gone short here, you would have picked up on this whole short movement here. On this one, if you would have gone long, we go here and the stock goes up for a period of time. So those crossovers are a good place to look at for confirmation that this trend is happening. So the MACD performs best during trending markets, especially when combined with MACD crossover. The challenge for most traders using the MACD is once the crossover happens, how much of the trend is left. So what we just looked at, it was a pretty short period of time. It would have worked, but you wouldn't be in the trade for very long. So the MACD can be very effective. Here's what I look at when I'm trading the MACD. I look at the histogram. So if the histogram peaks and then starts to go down, I don't wait for this crossover. So if you were to go, it's about right here. If you were to start thinking about going short and then you saw this red candle, you'd be catching the vast majority of the downtrend. Once again, here where the histogram bottoms and starts to go up, that's right about here. This is actually a little advance of the move. And then it starts to go up, and that's your confirmation. You would have actually caught a fairly good portion of this move. Once again, when it bottoms here and you see it here, you've still got a fairly nice move there. So you can use this histogram as a good indication of when to get in and when to get out, and some trend reversal there. That it when it peaks and it starts going down, it's time to start to go bearish or at least get out of a bullish trade, and vice versa on the downside. So there's a lot of ways that you can trade this. If you look at the MACD and you see the histogram is sort of bottoming here, this is a great place to buy calls or sell put spreads. When you have a MACD peaking here, that's right about here, this is a great place to buy puts or sell call spreads. And you can see how effective this is. Every time the histogram begins to turn around, we have a turnaround in the market or in this particular stock. Very, very effective. And one of the reasons for that is because like I say, it's an indicator that a lot of people use. It's also very effective, which is why they use it. So our third indicator is on balance volume. Now, this is a little bit different than straight volume. So as you know, you use volume to confirm a trend. If you see a breakout on a stock, you want to see higher than average volume. It's kind of a voting mechanism. And so you want to see a lot of people getting into that, really driving that stock higher. It's like everybody agrees this thing is going higher, and that helps propel the stock. If it's on low volume, you can't trust that move so much. So on balance volume is kind of a cool indicator if you like that validation that volume provides. So the on balance volume takes a lot of volume information and it compiles it into a single one-line indicator. The indicator measures cumulative buying and selling pressure by adding the volume on up days and subtracting the volume on down days. So ideally, volume should confirm trends. A rising price should be accompanied by a rising on balance volume. Falling price should be accompanied by a falling on balance volume. If it doesn't confirm, look for a reversal. So let's take a look at that and let's use on balance volume to see where a reversal might be coming. So as you can see, the on balance volume has been trending consistently lower on this particular stock in spite of some pretty big intermediate term rallies. So even though you had a huge rally right here in this period right here, look at this. In this period that the stock was rallying, the on balance volume was continuing to go down. In that case, you wouldn't trust this uptrend, or you'd be looking for a spot to reverse and go short on this trend. And a good spot would, on balance volume confirms that it's going lower and people are not investing in this, even though it's going high. It's going higher on very light volume. And then you see this turnaround in the histogram, and you see that this is at the top of the Bollinger Band, and all three indicators line up that this is a fantastic time to go short. And obviously the reverse is true when you've got a bullish stock and the on balance volume is rising. So this is a really practical way to see when these reversals are going to happen, is when you see all of these indicators lining up. So once again, we want to look for divergence between the indicators to try and pinpoint market reversals. You're kind of ace in the hole, and what tells you whether or not traders are really coming into a stock or moving out of it is this on balance volume, and that's why I like it so much. Most often, the market reverts to its previous trend, and on balance volume confirms that trend, even if the market reverses temporarily. So, really, it's this one that we saw here where you see the stock going up, you see the histogram going up, so you don't fade it until that histogram starts to peak, which is right in here. It would have caught the top of this, and you could have, you know, actually either sold call spreads or bought puts. This would have been a really great trade. It fell quite a bit and very quickly. And the on balance volume told you that this uptrend here was likely to reverse, even though we had a higher high than these two previous highs. And if you're just looking at the chart, you might think, okay, it's ready for a breakout. But the on balance volume told you that it wasn't. It's not really going to move in that direction in a sustained way. So look for the divergences between indicators, look for them and try and pinpoint market reversals. We just talked about that. And here, this red arrow is involving the histogram going down. For confirmation of a turning point, look for divergence in price and also in the MACD histogram. And this combination of indicators works well for straight directional trading, but it works even better for the strategy that I'm going to introduce to you today. It really starts stacking the odds in your favor. So the beauty of these three indicators is they're not correlated. They work together to confirm trend or market turning point in a trend. And when all three tell you the same thing, you've got an extremely high probability setup. They work well for directional trading, but they work even better using a strategy that gives you a massive probability advantage. And when you think about it, what we're doing with the stock market, what we're doing when we trade, with either we're buying straight stocks or we're trading in options, we're really working on probabilities. A lot of people, when they start trading, they look at a trade and they look at what it's doing and they say, okay, how much could I make on this? And a better question, and what the more experienced traders ask, is what's my risk on this? And if you can get your risk low enough, then the profits will take care of themselves. So what's the best strategy to give you a massive probability edge? What's that killer strategy? So what's cool about this is so effective, you can make money even if you don't time your indicators perfectly. So the trick to making money quickly, easily, and consistently is using these three indicators for direction, but also use a strategy that stacks the deck overwhelmingly in your favor on every trade automatically. And the way we're going to do that is we're going to jump on that other side of the options probability curve, and we're going to become an option seller instead of a buyer. And I'm going to show you right now how to stack the deck over 80% on every trade. And those three indicators that we just took a look at will just increase those probabilities of winning. In June we did, or excuse me, in May we did 10 trades. We do 2 trades per week. It comes out I introduced the trades late Tuesday. Most people read the report and get into them Wednesday morning. We do a more conservative trade. We do a more aggressive trade. But if we have a month with an extra week in it or an extra opportunity to trade, we end up with 10 trades instead of 8. So it's typically 2 per week. So in May, out of 10 trades, we won out of 9 out of 10. In June, we won 9 out of 10. We're on a really good track this month. And you just sort of get used to winning. And the reason is what I'm going to show you right now. So the killer strategy is to sell credit spreads that have an 80% or better chance of expiring or winning, expiring out of the money. And they can kind of work in spite of direction. But if you combine these indicators and some common sense, some of the things that you've already learned about trading, just the likelihood that you're going to win is very, very high. So let me give you some examples here, and then we're going to get into the seasonality of what's going on right now, what to look for in the next couple of weeks. And then I'm going to show you some actual trades based on what the market's doing right now. But I want to just get into the theory of this first. So normally, if you had an uptrend like this and a stock, this happens to be the SPX, was hitting the top of its trend line, this is the actual commentary from when we did this trade. This rising wedge pattern suggests we could see a pullback, at least down to the uptrend support line, before a sustained move higher, which is why we're going to sell a call spread above resistance on this index that is starting to roll over. And it's starting to roll over right about where you'd expect it to, right at resistance. Now, this doesn't mean it's going to plunge to the floor, but it probably is going to go down to this rising support line. So what we can do is go ahead and sell a call here. In this case, it was up at 6,100, and we buy another call to hedge. We typically, that's a $5 spread. Here's the math on that. And we typically bring in $1. So that's a $4 risk. And with a $1 potential profit, that is a 25% return. Now, here's what's cool about this, and it's in a fairly short amount of time. So we typically just sell about 10 days at a time. By the time you get into Wednesday, it's already 9 days at a time. 2 of those days are the weekend, so you have no risk there. The market's not moving. So you're really only talking about 7 days of exposure to the market. You don't even have to know when to get out of this. It's just going to expire. You've got a finish line already set in stone when this play is going to expire. And all that has to happen is the SPX doesn't have to go through your strikes and you're going to win on this deal. So just a real quick synopsis of what a stock can do. So after we enter this trade, this index could drop like a rock. If it does, we make our maximum profit on this trade. We make our 25%. Or it could go down just a little bit and we'd still make our maximum profit on this trade. Or it could go sideways and we'd make our maximum profit on this trade. Or it could actually, we could be wrong a little bit. Like I say, our indicators could fail us and it could go up a little bit and we'll still make our maximum profit on this trade. The only way we can lose on this is for this thing to go straight up and just keep on going. And the likelihood of that is low. And so, as you can see, out of the 5 possibilities that a stock can do, we can make money on 4 of those. But I'm going to get more specific here and get down to actual percentages based on the Black-Scholes options pricing model. So what happened on this particular trade, and this is why I want to show you some of these historically, is it gives us, this type of trading gives us so much flexibility. So what happened is yes, the SPX did roll over. It came down here to support. Here we have horizontal support. We also have uptrending support. So we're selling below 2 support lines. We got a big green bar heading higher, indicating it was probably going to bounce. And so what we did is we went ahead and we sold a put spread. And that's we sold the 5,800. We bought the 57.95. We took in another great credit with a new expiration. And we actually made money on the call side of this, and we made money on the put side. And that's what I love about this. It gives you a lot of flexibility and a lot of opportunities to win. This is Palo Alto Networks. You might know about them. They are a cybersecurity company. They've done really well. They've got plenty of volatility here. They generally go up, but they do it after a trending lower for a while. So you see these trends lower, big upside, another trend lower, big upside. We sold right before one of these big upsides. We started to see it come up on this big green bar here. So we sold a put spread here. As you can see, it expired out of the money. We did really well. It just absolutely ran higher. And then more recently, it went down again. We saw this gap higher here, always a good sign after coming down. So we sold another put spread here. So once you get your favorite stocks, and the kind of stocks to do this on are stocks that have plenty of premium in them. You know, they're probably big movers like Palo Alto Networks. They've got a decent stock price. This is obviously between $350 and $400 a share, so you're going to get really good premium. And they also have weekly options, so you can absolutely set and determine when you want that expiration to be. And so ideally, we're in these, like I say, about 9 days, 10 days. It's really the sweet part of the time decay curve where the time is going away fairly quickly. Every day of time decay actually makes a difference. And so even if the stock didn't go anywhere and just stayed there, we would still make a maximum profit on this. So compare that to buying a straight call or a put, where if the stock doesn't do exactly what you think it's going to do and do it in the exact amount of time you think it's going to, you end up losing money. So the reason I like this and the reason I like doing a subscription service for this and advising other people what to buy and sell is I'm pretty confident people are going to make money. Because like I say, all other things being equal, you win. So what you don't want to do if you're giving out trades to people and making recommendations is to recommend things that they lose on for two reasons. Number one, that's not what you're here for. You're not here to lose people money. You feel bad when they lose money. And also, from a more practical and a business standpoint, if they lose money, they're going to quit your service. So the whole idea is to build up subscribers, make them money, do what you say you're going to do, and then people tend to stay on for a long time. Since we switched to this, I've had an options advisory since 1999. Since we switched to this in 2011, people tend to stick around a really long time. And I've got some of our original people that have been with us since the switch for 10 or 15 years. They're so loyal, they don't go anywhere, and they just use this as their bread and butter strategy. And if you like to speculate, you can go do that with a smaller amount of money. But for the vast majority of your options trades, this is such a great way to go. You can do it on the downside as well. Here, UPS, this is the actual commentary and this is the actual recommendation. UPS has jumped over the past week based on earnings hype, but the economy is weakening, so earnings will likely reflect that. Plus, the momentum is rolling over. We had a nice trend here, pretty easy to follow, where every time the stock hit towards the stop of this, the top or hit up against this downtrend resistance, it rolled over. We had a situation where it did that. We just took advantage of that by selling an out of the money call spread. And you can see that here, 152.50 and 155. That's a $2.50 spread that we got 57 cents in credit on, and divided by 193 or $1.93. That's our risk. That's a 30% return, which is a great return for 9 days of time. But what I really want you to notice is your likelihood of winning. So here we have this downtrend in place. We've hit up against resistance. The histogram on the MACD is going down. The on balance volume is going down. And we're selling a good distance out of the money. So your likelihood of winning on this is really high. And I don't tell you that so that you bet the moon on every trade. I don't want you to do that. You want to use good money management techniques. There's always another trade coming, so you don't have to bet it all on one. But just your likelihood of winning on every and each individual trade we make is really, really high. And I like that because we don't have to be so good. The strategy's good. Once you put those probabilities in your favor, you can sleep pretty well at night. And this time decay happens with or without us. I'll show you how to enter a stop at our sold strike, exactly how to do that automatically. So you really don't even have to watch your trades once you place them. It just kind of generally works out in your favor. And when it doesn't, you're out of the trade at a kind of a much less of a potential loss than you would have before. It's just a system that works out really well for both time and cash flow. So once again, here's the actual commentary. This is when the stock market had reversed a little bit. It was starting to go down. The SPX is having a hard time recovering its previous uptrend. We might be seeing some of that coming up, and we're going to address that here in a second. And it made it up to its old uptrend line, but that often turns into resistance once it's broken. So many market caps trending lower. The SPX will likely trend down from here. That's exactly what happened. So it kind of hit up here. We saw this downtrend, and we realized this is a really good time to sell a call spread. So this is what we do on the SPX. Our call spreads are always $5 spreads. And we sold this call. We bought this call just above it. We ended up with our standard. This is kind of our standard. What we go for is a $1 credit and divided by 4. That's a very reliable, based on this trend, 25% return. The key with this whole thing, and once again, you see where the MACD kind of validates this, the histogram's going lower. Our indicators tell us this is a good time to make this trade. The way to make money in the markets is to make consistent profits. And 25%, if you get out your calculator and you start doing that every week and a half, every 9, 10 days, you're going to end up doing really, really well. You don't win on every trade, but if you trade this way with this kind of a percentage of winning, you can afford to have a loser or two in there and you'll be fine. You'll still end up very, very profitable in the long run. And it's also a really easy way to trade. You don't have to be looking at your screen all day, hovering over your mouse, trying to get in exactly at the right time or get out. And that's probably what I like best about it is this is something you can do for years with relatively little stress. Okay, so I talked a little bit ago about pinpointing your exact percentage of winning. So when we go to sell a call, what we can do is we can look at that, and I'll show you if you come on board. I'll show you how to set up your layout for implied on Thinkorswim. I think they're the best broker for options trading out there, uh, so that it'll show your columns will show implied volatility and probability being out of the money, and over here is the delta. And you can see all these columns here. But this probability of being out of the money is what we're interested in because when we sell an option that's all time value, and if that ends up out of the money, we're going to win. So what's kind of cool about this is you can see your actual probability of winning before you ever place the trade. In this case, it's 81.99%. We try and do that right around 80% or better. Sometimes we do a 79 or a 78. And sometimes we do above 80, like in this case. But just imagine if you had a chance to win $1,000 or $500 every time you bet, and every time you bet, you had an 80% chance or better of winning. How many times would you do that trade? How many times would you take that trade? And I would suggest you would do it a lot. I use the analogy of if you've got a friend that had a coin from the novelty store that ended up heads 80% of the time or more, and every time you called heads, you got $1,000. How many times would you stand out in the backyard and flip that coin? And I suggest you'd probably be out there until the cows, till it got so dark you couldn't see. Those are pretty tremendous odds, and especially when you combine our indicators. So let's just take a look at the seasonality and see kind of what's coming here. So today is July 22nd. We've only got 1 week, approximately 1 week left in this month. And we'll see that now this goes back to 2005. So this is 2005 to 2024. And this is the S&P 500. And this tells you what are the really bullish months and what are the more bearish months. So you see right here, April is a pretty bullish month. Why would that be? Because that's the month that earnings are introduced or earnings are reported. So companies have done a very good job and they've gotten very good at lowering expectations so they can beat their earnings numbers. When they do that, the market gets really excited. They don't take that into consideration. They just look at this top line beat and they buy. And so we've got the first quarter here is January, February, March. Earnings come out in April. And earnings, the ramp into earnings is usually really bullish into those first 3, 4 weeks of earnings season. And they get announced. April's a really bullish month. May comes off a little bit. June is actually relatively bearish, a relatively bearish month. We've got that ramp into earnings. And then once again, we've got a really good earnings month in July. That's where we're at right now. But look what happens. Look at what happens when July transitions into August. So there's some pretty big events coming. Everybody talks about the Mag 7. And we've got Tesla and I believe it's Google announcing earnings tomorrow after the bell. That's Wednesday. And then we get 4 of the Mag 7. That's over half of the Mag 7 announcing next Wednesday and Thursday. So that's we've got on Wednesday, we've got Microsoft and Meta announcing huge market movers, huge market caps. And then the next day we've got Amazon reporting and whatever the other one is. And then NVIDIA is out into August. They're kind of the outlier. So once that happens, so that's, the last couple of days in August. Once that happens, even if they announce really great earnings and the stock pops higher, the enthusiasm starts to fade almost immediately. And traders have these big gains that they want to book and they want to realize those profits from the July run up. August is a really good time to do that. Typically, we'll see the market trend lower in both August and September. And then the first half of October, look at how bearish October is. We get these kind of waterfall like declines into the first half. And then typically the last, October's an earnings month as well, but the market's been going down for the last 2.5 months. So traders aren't nearly as bullish. So they tend to sell into October. And then about halfway through October, about October 15th, we start to see that market rise into another very bullish month here in November. So this is the pattern. So when we're thinking about doing either bullish setups or bearish setups, you kind of have to ask yourself what the seasonality is and what's liable to happen. There's very few stocks that are able to resist the pull of the overall market. So even though the Mag 7 have done really well, I think they're going to produce some good earnings. I think people are going to like the earnings. There's a good chance they could pop higher, with the possible exception of Tesla tomorrow after the bell. I'm not sure they're going to announce such great earnings, but the others should do pretty well. But they still might trend lower in August. And I think that's just a really good thing for you to keep in mind and keep on your radar. So how is that going to inform our trading decisions? This week should still be good. Here's a stock. This is a tech stock. They help companies interact with their consumers. They've got software around that, how to introduce programs, how to monitor those programs, how to keep a track of things. They've done really well. They announced earnings in May that were excellent. And we actually did a put spread on them here back in May, did really, really well. We're seeing the setup again. So you'll see where the stock has a tendency to go sideways for a while. That's what we've seen here moving along in our channel, and then it breaks higher. So just this past week, Twilio broke higher and it's pulled back, and then it pulled back again today to its uptrend line. And so a trade that looks really good is we would sell right here the 125 puts. We would buy the 123 puts to hedge. This is only a $2 spread right here. The current credit is 41 cents. And so that makes us only have a risk of $1.59. If this expires worthless, and indications are it will, as Twilio starts to head higher, you'll see that the MACD is heading higher. The on-balance volume is heading higher. Everything is confirming it. And this spread right here would yield a 26% credit fairly safely. You can see that the stock dipped. This is actually a chart from today. So you can see the chart dipped a little bit, hit uptrend support, and immediately bounced off. Looks like it's going to close higher on the day. This is exactly what we want to see, and this is exactly the type of stock we want to sell a put spread on. That's just something for you to keep in mind if you want to kind of write this down and see how it will turn out. Go ahead and do that. I think it's going to be a good trade. Here's another one, NVIDIA. So they're not announcing. They've got this beautiful uptrend, and it's been confirmed many times. It started here, bounced off of it. So this is uptrend support, big green bar off of it here. It hit here again and had a really nice bounce off of it. And then it just came down today and hit its uptrend line again. So we'll see how this trades, but it's looking pretty good. So if we start to see this little bounce, and we've already see it come off of its lows today, people love NVIDIA, they love the prospects, and they're still buying. And one of the nice things about NVIDIA is we don't have to worry about it announcing earnings, but we do have to worry about those companies next week and how the market might drop after their earnings are announced. It's kind of a buy the anticipation and sell the news, buy the run up and sell the news. So on this one, we're going to keep it on a fairly short leash, and we're just selling out to this Friday. But even with that, we can get a pretty good credit right now. Or when I looked a few minutes ago, it was 41 cents. Our target on this would be 50. We're selling the 162.50 and buying the 160. If this uptrend continues, or even if it trades sideways, we've just got a few days of time here. Time decay is going to be really steep on this. We're going to win on this trade. So take a look at that as another one for like what's happening now. And just so that you know that we're not always bullish all the time, we just kind of go whatever that stock is telling us. There's also bearish trade setup. So Tesla came out with their deliveries a little while back, and their deliveries weren't as bad as expected. They weren't great, but they weren't as bad as expected. And the stock started trending higher. Now, as we know, tomorrow night after the bell, they're announcing earnings. Normally, we don't do spreads over earnings because this is a strategy where we don't want a ton of volatility. We want it to just keep kind of trending and doing what it is. But occasionally a setup comes along where it's good enough that we can take advantage of it. So right here, if we sold the August one, so we're going to go out a week and a half to kind of get into that possibly more bearish period after all the majors announce. So if we sell a 360 call, we buy a 362.50. Um, our target is 50 cents on that. We're very close to that now. You can see it's been trending higher, but it's going right up against this downtrend resistance. Why would I be bearish on Tesla? You know, I love their cars. I think their cars are the coolest thing in the world. I think Elon Musk is a colorful character that's done some amazing things. His companies have just flourished. But Tesla is losing market share in Europe. They're rapidly losing market share in China because BYD is produces some incredible cars. The Chinese would rather buy a Chinese made product, all other things being equal. But BYDs are excellent cars. They sell them for less than Teslas go for. So that's a major market for Tesla. They're losing market share there. And they're starting to lose market share here in the United States as some really good competition starts to come on. It's taken a few years, but you know, a lot of companies are making really great electric cars now. And then you also have the federal tax credit coming off at the end of September. So you combine those and you can understand why the chart on Tesla has been sort of trending lower. And we had a huge drop off here, and then we had a rebound, and then now we've got a new trend heading lower. The MACD can't really get out of its own way here. It's just hovering right along the zero line. We've overall got some downward on balance volume. I would not be surprised if Tesla's report isn't quite as good as investors were hoping, and we see a downturn on this. Like I say, this is more speculative. We usually don't hold over an earnings announcement, but if you wanted to take advantage of those huge premiums and have a chance to sell way out of the money, this would be a good way to do it. One of the things that you can do is not keep a stop on this particular trade because sometimes you have some volatility right after the announcement. You don't want to get stopped out and then have the trade end up being a winner. So I think overall, considering the seasonality of what's going on in this transition from July into August, and the fact that Tesla might not produce and announce the best earnings that people are looking for, I think this has a really good chance of dropping lower. And a credit spread is a really great low risk way to play it. Of course, you can also buy puts, but those can expire worthless if things don't happen exactly when you think they're going to. So this is a trade you also might consider. This is one that you can trade on paper if you like, or if you even want to trade it yourself, do it with one contract or so and just see how you do. If you don't want to speculate so much and you're just looking for a pretty solid trade to the downside that has a really good chance of working out, this is Procter and Gamble. They do have earnings coming up next Wednesday on July 30th, but their earnings don't typically move the stock much. It's a pretty low volatility stock, so we can sell pretty far out of the money here. We can sell a 162.50 call. We can buy a 165 call to hedge, and we can collect a really nice credit. The current credit is 42. If we get just a little bit more upside, it was already 50 today. We might see that again, but anywhere in here, 45.50 is good for a really low risk trade that has a really good chance of expiring in your favor. And once again, we're using that August 1st expiration. So we're only talking, it's 10 days from now. The day is mostly over. You get into this one, you've only got 9 calendar days left, 7 actual trading days. And this one has a really excellent chance of expiring in our favor. So that just gives you an idea of how the strategy works. There's some actual trades that you can take advantage of right now if you want to. And And it's just a really nice low risk way to trade where you've got these paydays coming in most every Friday and you don't have to do anything. You don't have to manage them. They just expire on their own. You can check in over the weekend, see how you did. You can check your trades periodically. We set automatic stops so you don't have to watch them that closely. It's a really nice way. The reason I show this couple having fun going down the road in a sports car is because it's really kind of a lifestyle trade. It's a great way to make some money in the markets, be involved in the markets, put the probabilities in your favor, and just not have to watch things too carefully. So your odds of winning with this strategy are extraordinary, but the real appeal might be your ease of trading. And once you put on the trade, you enter a stop where I'll show you and walk away knowing you have over an 80% chance of winning. And even if you don't win, your potential losses will be cut in half based on the automatic orders I'll show you how to enter. So not only do you have an overwhelming chance of winning, but you get to enjoy a pretty carefree lifestyle as well. And we target 25% per trade. And so what can you expect to make over time? And you'd say, well, if you're getting 25% per trade, you're winning most of the time. So, we need to set aside some cash for buybacks, for cash holds, for losses. So we're not trading the entire account. So, what's reasonable to expect? 20%, 15%, maybe 10%. I think you can do at least that good or better. But just to show you how well this works, because we turn the money every week and a half, if you were just getting 5%, and that's an amount I know anyone can make, let's see what that looks like starting with just a $10,000 account. I think you'll find this kind of inspiring. So you see this sort of exponential rise. It starts off fairly slow, but you're making profits on your profits. And eventually this thing just goes through the roof. After 2 years, 10,000 has grown into 104,000, and you're bringing in over 10,000 a month. Now, I know what you're probably thinking right now, and I would think the same. Well, this is a great chart, Peter. It's all wonderful, but absolutely nothing works out that well and that uniformly in the real world. You have losses, you have downturns. Sometimes the market doesn't do what you think it's going to do, and it just doesn't work out that way. And I agree with you, but what if it's even close? You're going to end up doing pretty well. And we've got a lot of very happy subscribers that have stuck with us for a long time that can attest that this works incredibly well consistently over time. So you can try the strategy out for yourself. I just kind of showed you how to do it. And you can start with as little as $200 per trade on a 250 spread. You get 50 cents. They're going to hold that margin in your account. So you can start with small amounts of money. Prove to yourself that this works. There's just one problem, and that is if you don't make money right off the bat, you might get discouraged and quit. And I don't want that because this strategy is so darn good. That would be a shame because this really is the best way to trade based on your high likelihood of winning, the hands-free nature of the trading, and the tremendous compound returns over time, which is what we just saw. So to make sure you start off profitably and stay that way, I put together an educational package that's the best anywhere for this strategy. And we used to charge $2,500 for this. I would sell it on cruise ships. There'd be an investing cruises where a whole group of investors would go out and present this to them. They absolutely loved it. I still hear from some of those people today. They're delighted with the amount they paid. They're delighted with the returns. But I decided to roll this out to a much broader group. And the only way you can do that is to dramatically lower the price. But what's ironic is I've added so much to the package since then. And you're not going to believe what this includes. Nobody else does this, but I think it's going to blow you away. So the package itself is called The Winning Secret. And it includes this initial introductory webinar, which is how to trade credit spreads for fun and profit. Shows you step by step how credit spreads work, why they work so well, and why they can work for you. I think you're going to love this. Even if you're a little confused right now or don't understand how they work, you will once you finish this. So you also get a 161-page downloadable ebook complete with charts, graphs, pictures, everything you need to start trading profitably and stay that way. You get a 10 chapter video series. Completed this just not that long ago. It's really dynamic. It's really fun. It's exciting. Each video is not too long. You can get through it. You can understand it. You can rewatch them. You've got, time and stop and pause controls. You can hear exactly what to do to start generating this income. And you'll also gain access to archive webinars and video tutorials so you can discover new strategies and ways to improve your returns and limit your risk. And you'll have access to all of this education as it's being updated for life as an owner of the package. So that really gives you a comprehensive education, outlines what to do, what not to do. I'm also going to show you how to set automatic orders to trap money, trap profits, and limit your risk. And that's sort of the lifestyle part of this. And this is something I show you how to do with Thinkorswim. They've got this really sophisticated software that allows you to get in and out of your trades exactly when you want to without having to watch them. It's fantastic. And this is where the rubber really meets the road. This is where you and I are going to have a chance to go out there every Tuesday evening, Wednesday morning, and trade this together. I give you a really comprehensive breakdown on each trade. I tell you exactly where to get in, where to get out, what to sell, what to buy, how to protect yourself to maximize your profits and minimize your risk. And this is, I think it's $99 a month. And I wouldn't worry about that too much because I'm going to include your first month. And then after that, I think the market should be making you plenty to pay your, one trade can pay for the entire subscription for the whole year. So I don't think that's going to be an issue, but I want you to know that you get this and it's really comprehensive. I put a lot of work into it. I'm going to put it out tonight. If you come on board, you can be looking at it tonight or tomorrow morning and getting into the trades that we recommend. As an extra bonus, you're going to get a 10 module video course specifically on trading the weeklies. This is the best thing that's ever happened to options. They started being introduced in 2012. Now everything that's really heavily traded has weekly options on it, and I find you the best ones. This is Deanna. We all know the best way to learn is to get some one-on-one instruction. I don't want you to come on board and then feel like you're an orphan and you don't know what's going on and we never talk to you again. So we're going to give you a one-on-one introduction session. She can see your screen. We do a little screen sharing. She can show you what to click on, what to expect from the service, the right kind of brokerage account to set up to get the right clearances. She just walks you through so you really feel like you've got somebody taking care of you and holding your hand. Even if you've never done this before, you're going to feel really comfortable. She's fantastic. I love her. She's super friendly. I think you're going to like dealing with her. The orientation only takes about 20, 25 minutes, but it'll make a huge difference in your confidence level and feeling like you can do this. And this is kind of the coup de grace. This is the icing on the cake. Like I say, nobody does this. Options coaching packages, if you look around on the net, they're typically $5,000 to $15,000 for a package. And I think I've got a coach here with Alicia that's better than anybody else out there. She was a finance major in college. She's absolutely brilliant. Plus, she's got a fantastic, very friendly personality. You're going to like her a lot. She's the one that I go to when we talk about new options trading strategies. We're actually developing a program right now on 0 days to expiration options, kind of the hottest thing in the options market. About half the volume in options now is in that. And we're developing a program for that. And she's the one that I'm working with. She's got a really good mind for math and numbers, very computer savvy, and she really knows how to find great trades. And we sell these in 8-session coaching packages and 3-session coaching packages. We've got a bunch of people that buy coaching packages 8 sessions back to back. And is that because they can't figure out what a put or a call is? No. It's because Alicia's very good at showing them how to use the platform to find really great trades and really great trade setups. And so she helps people make money. She doesn't trade for you. We're not brokers. She's not going to tell you exactly what to buy and sell, but she can tell you when a setup looks really good and she can show you exactly how to find it. So no matter what your experience level is, even if you've never done this before, you're going to, I think, really love a session with her. In this package, I'm including a 45-minute personal coaching session. Obviously, we want you to continue with her. I think once you do, you're going to want to, but you're going to see how good coaching is and how enjoyable it is and how fun it is to go out there and find money in the market. And it's all included in your package. Nobody else does this. Nobody else gives you that personal one-on-one attention And I want you to just have the best when you come on board. I want you to be with us for a long time. And the best way to do that is for you to be making money. So we put together an incredible package. You can see it all at thewinningsecret.com. David, if you want to post that link, that'd be great. And it's really nice to have a link to go to. When I enter it in my browser, sometimes it takes me all different places. But I put together this really nice package that includes everything. And it's been wonderful for people. I think if you get it all, you're going to be with us for a long time. Really fun to cash flow the market should trade. You can pay for all of this with just one 5 contract trade. It's really fun. Really nice to get used to winning. And I'd love to have you on board. We've only got about 3 minutes left. And David, I don't know if you're all queued up for the next speaker, but if you want to shoot me some questions, if we've got just a minute or two, I can sure answer them. So, David, do we have any questions that people really want to
Um,
know?
yeah, let's see. With a $10,000 account, how much do you use for a trade? That's one question.
With a $10,000 account, I'd keep about half of it, or at least 40% of it, for buybacks and cash. So that leaves you about $6,000 to trade with, on a $5 spread on 10 contracts. That's going to be 4,000. So I'd probably trade 5 contracts on that. I'd trade about and we're only doing 2 a week, and they overlap into the next week. So I'd trade about $6,000 of that. Probably start off with about 5 contracts per trade, and then as your account builds up, and based on the probabilities, it builds up pretty quickly. You can increase the number of contracts that you do. What's next?
Okay. Uh, one more quick one. Do you use seasonality on individual stocks you pick?
I do, and it's very hard for an individual stock to buck the overall market. So even if you take a Microsoft or a Nvidia, something that's very, very bullish, if the whole market's going down in August, those stocks are going to go down too. There's no guarantee that they just continue higher. And people and traders that have a lot of profits built up in those stocks that have held them for, several months, they're going to want to realize those profits, and they're not going to want to see them slip away. So they sell. And when enough people do that, even those really, really great stocks go down. So, yeah, I absolutely take seasonality into account. And we're going into a really critical period. This next week is where we could really see the market change, and particularly over the next 2 weeks. So, this is a time to be careful. This is a time to kind of look for a trend change. I think it's kind of happening now. And I'm really glad this webinar happened right now because we can kind of get positioned for that. Do we have
Okay.
time for any more, or is it
Yeah,
time to
I
go?
I think that's it.
Okay.
Yeah, I think we're out of time. So
Okay.
thank you,
Well,
Peter.
thank you, Dave.